C-class assets are really the workforce housing of America. So you're talking about your janitors and bus drivers and truck drivers and waitresses. And, it's really how America runs. And so there's always a need for it. I'm now in my third downturn of my career. And what I've learned from the downturns that we've been through is that C-class multifamily assets are what I find to stay most true and to stay strongest and steadiest through both the upturns and the downturns.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Amy Rubenstein. She has 20 plus years in real estate, and I enjoyed hearing her story. Really through three downturns, right? Or she's in her third downturn now. She elaborates on a number of things that she's learned right through those downturns that she's applying today. But also, how's that affecting interest rates, or what's happening with interest rates? How does this affect, the type of assets she's going after, which are highly distressed properties and very large ones at that. And so you're gonna hear why is she doing that? Why does she like this type of asset? Her team, even their ability to raise equity right now. They're doing a very large fund and quite successful at raising a lot of capital. So you're going to hear why she's focused on the types of investors that she is focused on also. Amy, welcome to the show. I love your dedication to getting this done. Just so the listeners know, she had a flight cancel yesterday and is in the Central Time Zone. I'm in Eastern Time Zone. She's up at 6 o'clock in the morning recording an interview. She didn't cancel it. She just rescheduled it or to earlier in the same day. So I'm grateful for her dedication, and that's what it takes, I think, in any business, especially as the chief problem solver, which is what she called herself, but the CEO. Amy, welcome.
Thank you so much. Really nice to be here.
Yeah, nice to meet you. And I love diving in on some of the topics that I know you are an expert in. First, give us a little bit about, your business, Clear Investment Group, your background. You've been in real estate 20 plus years, which we mentioned in the intro, but give us a little more detail there. Why real estate? Did you do something before that? What was it about real estate that drawed you to that? And let's talk about a little bit of that path getting to where you're at today.
Sure. I started real estate 20 years ago. I fell into it by accident. It's hard to take a lot of credit because the market was on its way up in 2003. So it was pretty much anything you touched turned to gold. So that was a really good, easy time to learn about real estate. I fell into it by accident because I actually bought a house and sold it pretty quickly and had rehabbed it and made some money on it. And so I thought, this is kind of interesting. So I bought a condo and did the same thing, and it did well. And I thought, well, maybe this is something I should learn about. And then that was probably around 2002-ish. And I started studying to get my broker's license, and then syndicated a really small building, 6 studio apartments in Hollywood, and bought that building and then sold it 6 months later, bought 2 more, sold those, bought 4, and so on and so forth. And that was the start of my career, based out of Hollywood at that point. And then it kind of took off. So I was in California the first 10 years of my career, buying buildings that were larger and larger until 2009 hit, which was the real time to learn about real estate as everything started to crash and crumble. California was interesting because everything sort of just hit a standstill. No one was buying, no one was selling, and we had to figure out what to do. So it was at that point I started buying and selling foreclosure homes, because that was the only thing that was being foreclosed on at that time. And I had all these properties, but I couldn't sell them. So buying and selling foreclosure homes, I think we did 70 of them in 18 months. So a lot, but that wasn't my business. So I had to get back to apartment buildings, which was really where I was focused, and dabbled in some other things, office, industrial, but apartment buildings was what I really like to focus on. So in about 2010, I started to see deals other places around the country. And at that point, I was only in California. Started to see deals around the country that were going under foreclosure, that were larger deals. And the crazy thing was that these deals were actually produced cash flow in our models. And at that time in California wasn't really a cash flow market. It's really more of an appreciation market. So this was an unusual thing for me to see. Is I thought, wow, there's foreclosures here and there's cash flow. What a novel idea in real estate. So I started buying things outside of California, then ended up relocating to Chicago, which is where I'm originally from. Worked in Chicago for a little while, or for a long while. I'm still based out of Chicago. And then started to look at deals nationally. And that's when I really started to branch out. Now we are all over the place. So I'm now in my third downturn of my career. And what I've learned from the downturns that we've been through is that C-class multifamily assets are what I find to stay most true and to stay strongest and steadiest through both the upturns and the downturns. And it was really what I was most passionate about as well. And so that's where my career has really continued and really had a focus. And while I've owned all these other asset classes, I just don't like the way they wear through the ups and downs as well. Um, Especially coming out of COVID and into now this downturn. Office never had a chance to recover. So that's a really fun thing to hold. I say sarcastically. And retail is it's similar. It recovered a little bit better, but it's just not where my love is. And so my focus now is really on large distressed multifamily assets around the country. So we just started our newest fund this past December, and our fund is purchasing apartment complexes in the size range of 300 to 1,500 units. And we really do go pretty much anywhere. We're looking for mostly managerial distress. So we're looking for things that are not functioning well because something fell apart on the management side. And then we start to stabilize things and then we sell them off. So that's the business now.
Yeah. Wow. Well, it's incredible. I love the background there, and obviously the experience through numerous cycles, right? And I want to talk through that just a little bit. And what I love seeing in entrepreneurs like yourself is like, okay, this isn't working, at least for this time. I'm going to pivot to I can just pivot. We're going to focus over here a minute. Like you started buying, selling foreclosures, 70 of them in 18 months. It's like even people that are just going to focus on foreclosures don't normally just jump in and do that many, right? So I just love the ability, right, to be able to just pivot. We're going to focus over here. We can just build processes and make things happen over here, and then you came back to apartments, right? You started seeing you pivoted again, right? You went nationwide versus just in California. You saw properties that were actually cash flowing. But let's focus on let's say Class C properties for a moment,
Great.
and why Class C. And I've heard obviously different reasons why people love that asset class or that class of multifamily, but then some want just want Class A, right, or B plus, or right, and obviously the headaches depending on the type of tenants or location, those things. But why do you love Class C properties? Why would you all focus on that? Especially, say, a 300 to 1,500 unit portfolio of Class C. That's a massive undertaking, right? I mean, if depending on the type of distress, of course, but elaborate on that a little bit.
C-class assets are really the workforce housing of America. So you're talking about your janitors and bus drivers and truck drivers and waitresses. And, it's really how America runs. And so there's always a need for it. So when the market is really hot, the D class gets a little bit hurt. Everyone sort of levels up a bit. And when the market starts to crash, your A classes get hurt. It's the first thing that people can reduce their rent by moving down to a B class building. C class seems to stay pretty steady. I also really love, I mean, not to sound overly altruistic, we are a for-profit, so I don't want to, but we do incredible things for these communities. We really are able to see a community that is not functioning well, where there might be crime or disarray, or things start to just feel depressed as far as the building itself and the way things are functioning. And we're able to very quickly turn it around to create a vibrant, functioning complex that people can feel really proud to live in. And I love watching that turnaround. It's very, very tangible. And we can see major differences. So, we're often taking things from maybe like a C minus to a B minus or a C minus to a C plus, but we're really making a big difference. And it's not so much in the we're focusing on a building that is not functioning within a community that is. And so then we're trying to get that building to function like the rest of those of that neighborhood or those buildings. And so the neighborhood itself will improve because the problems are usually coming from our properties. And I enjoy seeing that and watching that and getting to be a part of that.
For sure. I think I read on your website, or I watched your video on there, which was very good, by the way, the first little video that catches your attention. And you mentioned y'all are vertically integrated. Speak to that. You have construction management, asset management, obviously all that stuff in house. It sounds like, but what do you all have in house? And
Correct.
and is that would you say, hey, that's crucial to doing, to really performing on Class C properties?
Yes, I think the most crucial thing is our management. So we have, since we are vertically integrated, we do all of our own management, all of our own construction, and then our back office is based out of Chicago. So I would say the most important component of that is the management. I think it's very hard to hire third-party management when you're trying to stabilize an asset. It's hard to get the management company and the property owner aligned, and it ends up being a big game of telephone when you try to throw a management company in there. There's just too many parts and pieces moving in the very beginning to be able to use a management company. So I think that's the most crucial part. So what we'll do is we'll pull over a manager from another portfolio, or one of our area managers will head into that particular new submarket that we come into, and then we start to train up locally. We try to keep the staff that we have when we first take over, and then bulk that up locally, and then get everyone trained in our system. We're very process oriented. We're very systematic in what we do, the way we communicate with our managers, the kind of reporting that we communicate back and forth. So everything boils down to specific data points that we need to understand where the property's at, what sort of place we're in. And then, in the very beginning, it's that problem solver part comes out because there's all sorts of messes going on. And we have to just sort of, all right, roll our sleeves up and say, here we go, and start tackling problem by problem until we
Sure.
get it accomplished.
Yeah. Yeah. No doubt. Yeah. The management of almost any asset, but especially one like that, right? Is going to be just crucial. What about how are interest rates affecting your buying ability today? What do you think about just what's yeah, maybe we'll go there later as far as what you expect to happen, but today, how's it affecting what you're able to buy?
It's been an incredible opportunity for us. So when interest rates rise, we get really excited because it means a couple things. When the market's really hot, everybody gets into real estate because people are making money. And so other people see, well, that's a great way to make money. And so everybody starts jumping into real estate. And you see a lot of new people coming in. And a lot of people who've been sitting on the sidelines start to jump in. And so that really drives the market up. So it gets harder and harder to find great deals when the market's really hot. It ends up often becoming a game of hot potato towards the end. People are passing around properties and the prices are rising and rising. When interest rates rise, a lot of people get nervous and start to back away. It also becomes a little bit harder to get lending. So if you have great banking relationships, that's really crucial at that point in time. And so what starts to happen is because there's less buyers in the pool, the sellers have to really readjust the pricing, especially because interest rates are going up, so your mortgage payments are going up, and so we start to see prices really slash. And the difference in projections when you see the prices slash versus the interest rates rising, it makes the rising interest rate slightly negligible next to the slashing of prices. So it's still a number, obviously a factor, something we have to use to model with, but the slashing of prices becomes much more significant. And so it creates an incredible opportunities for us, less competition for us, and a great time for us to be buying.
What are your expectations over the next, say, 6 to 12 months in the real estate market concerning just the economy, as a whole, but interest rates as well?
Sure. It's been an interesting time to play fortune teller. And I try to tell people I will never play fortune telling in my modeling or in my everyday business mindset, although I love to play that game outside of that mode. So we like to, guess all the time what's going to happen, how's it going to go, but we just don't ever plan for that. We plan for the worst to happen. So I think, I mean, what everyone's talking about right now is another 50 basis points of increases over the coming 6 to 9 months, let's say, whether that comes in one bump or two bumps. not quite sure, that sort of talk on the town. At that point, probably will level off. It would be nice to see a decrease come later on after that. And I do think the market will start to correct itself and interest rates will eventually start to go down. When we look out as far as forecasting, what are we going to look at for the future? When we're buying in a down market, we are also modeling to sell in a down market. So we want to make sure that we're creating all of the value at ourselves and we are not an appreciation based company. So where my career started very much in a appreciation market, I now try to ignore appreciation as much as possible. I just don't count on it. So all value add has to come from us. So we are affecting the NOI directly and therefore increasing the value. What we try to expect is for interest rates to rise. Right now, we model for another 50 basis points, and we model for that interest rate to stay steady for the next 3 years. When we're in a downturn like this, we have to protect ourselves in many ways. So we try to touch every single variable and be conservative on every variable that the down market could hit. Because the one thing I've learned from multiple down markets is that every time a down market comes, it manifests itself in a way that we never expected it to. And so we don't know where it's going to hit us from or how it's going to hit us. And so we have to make sure that we're prepared in every type of way. And so interest rates is one of those ways that I just said. Another thing that we want to make sure that we're careful on is the cap rate. Because if we are expecting a high cap rate to sell at a high cap rate, that really helps protect us from a lot of effects of a bad market. So while typically we'll sell at somewhere around a 5 cap, right now things are trading around 6 caps. We're modeling to sell at a 7 cap. So it's a very, very conservative number. And then that really helps us so that when we're done with our product, we have the ability to sell in a downturn. So we also, sorry, just to tell you some more variables of how we protect ourselves. We also don't model for any rent increases in the market over the next 3 years. So it's another thing, just trying to make sure we're hitting any problems that we could have from this downturn.
Yeah. Yeah. So you said, so it sounds like, you're not modeling for any appreciation, not modeling for any rent increases either. Is that accurate?
Mm-hmm.
Yeah. For the first
Correct.
3 years.
We don't model for market increases. We do model to increase our rent to market,
Okay.
but we're not modeling once we're at market that it's going to go any higher than that.
Yeah. Okay. Okay. No, that's helpful. For sure. Well, let's speak to, how you're raising money for these deals. And what does that look like? You mentioned you all have a large fund now. And, I would imagine if you're buying a 300 to 1,500 unit portfolio, I mean, it's a pretty sizable project, right? But, who are the types of investors, that are partnering with you all on these deals, and just speak to your process a little bit of how you're telling them about the deals, right? And gaining their interest.
Sure. So we did open a fund in December, and we are about halfway through the raise of that fund. So it's a $100 million fund, and we're 50 into it. We work with all sorts of investors. So we have our legacy investors, people who've been with us for a really long time, mostly high net worth individuals. And then we have some larger institutional investors. Magnetar just came on board with us, which was really great to see. They just put up a good amount with us, and a lot of family offices. So we have a lot of different mix of who invests with us. I think that people find our thesis compelling in a place like this right now. I think our investors appreciate our conservative approach. I actually am not a huge risk taker. People think of real estate as a risky arena, but I'm not a very big risk taker. So we do look at very troubled projects and projects that need a lot of micromanaging and handholding. But that's just systematic. That's just part of our program. It's part of what we do. It's part of our model. And so while that might seem daunting and risky for others, it's really exactly what we do. So for us, it doesn't feel that way at all. So there are always problems that come up and always things that can happen, and we expect
Sure.
that and deal with it when it does.
Yeah, speak to building those or how you've built the relationships with family offices versus say the normal retail investor.
It's a lot of outreach and letting people know what we're doing and having them watch us through other deals that we've done. We have a really strong track record. So over the last 20 years, we've delivered over 40% annualized returns to investors. We've never lost any money through any of the downturns that we've been through. So we've held really strong through this. And I think that when people look at our track record, it speaks for itself. And we've had enough people do due diligence into it and really see that we've been quite steady over the years. And I think, we make sure that we always have a plan B, that we don't have one method of success. So for instance, when we're modeling for buys right now, we're making sure that when we first are coming into a building, the property might be negative cash flowing. So we're looking at something that could be a negative cap rate. In fact, people ask me all the time, what cap rate are you buying at? I don't even look to see what the cap rate is when we buy, because it's a number that we plug into our model, but it doesn't affect the decision of whether or not we will buy the property. Because what we're really looking at is, where is the property going to go? What is the cap rate going to be when we sell the property, and when we get the property to stabilization? So what we're looking at is, by stabilization, which we model out at year 3, that we're cash flowing in the mid-teens. So by year 2, we're sort of probably around 8%. When we're cash flowing in the mid-teens by year 3, our plan A is to sell the property at that point. We've stabilized, we've increased occupancy to market, we've gotten the income to where it needs to be, and it's time to move on for us. But if something were to occur in the marketplace at that year 3, something crazy like COVID comes up, or the market crashes, or something that makes an environment where we really can't sell at that point, we're sitting on a cash flow property in the mid-teens. So we're fine. And I think people appreciate, that stability of being able to hold on at that point in time.
What's the challenge you're facing in the business right now?
Lending remains a challenge because it's ever changing right now. And I think banks don't even know where we're going and where we're headed and what's going to happen. And especially, we do like to work often with smaller regional banks, although we've got larger partners too. Wintrust, Wells Fargo, these are regular partners of ours. But when some of these smaller banks are struggling like they are today, they really start to tighten up. And they're pickier on which projects they'll take, which borrowers they're going to lend to, and what sorts of programs they want to offer. We like to borrow with adjustable rates. And the reason we like to do that is because we're only in these deals, we're stabilizing by year 3. Even if we weren't to sell by year 3, it's time to refinance. We've completely changed the layout of the property from a financial standpoint, specifically, right, and as far as what I'm speaking to. And it's time to refinance and pull out funds at that point. And so right now, today, banks are really hesitant to lend at adjustable rates. They actually want to lend at fixed rates. So I think that's the biggest challenge today, is really making sure that we're aligned with our banks, which we've been in a great place thus far, but that is the ever moving target.
Yeah. Do you have a tip on how you're just keeping those relationships active or staying on top of what's happening with the banks?
As we look at, it happens to be that we're able to do more and more assumptions right now, which has been interesting and exciting, because we're assuming loans in the 4% range as far as interest rates. So when we're doing that, we're not generating new loans. We have to keep up those relationships with the banks. So we continue to let people know what we're doing. We're reporting more than ever. Banks are asking for more reporting than ever, really keeping people informed on what's going on from our side and what are we seeing on the ground.
All right, Amy, a few faster questions here at the end, and just I'd love to dive in on a few things here, different things I know the listeners want to hear from you. But what's your best source for meeting new investors right now?
Some of it's word of mouth. A lot for high net worth individuals, it is usually word of mouth. So our investors tell their friends or family who tell their friends and family, and it spreads like that. As far as our institutional partners, It's really outreach through a lot of networking connections that we have. We introduce ourselves to new people for a first time, someone that we've never met, but it takes a while to build a relationship that way when there's no introduction, and they'll look and watch us for a little while and then jump in when the time is right.
How do you do that? How do you introduce yourself to, like, at a networking event, or you find them online, or what does that usually look like for you?
Yeah, it could be through LinkedIn. We try to find some common connection. I think that we have a woman in our office who runs investor relations, and she's always trying to find new outreach and uh, figure out how to connect with people that might not know who we are.
What about your best advice for passive investors right now?
I would say just to make sure that you're looking at what is the end game as far as the modeling for the investment that you're going into. I just am very hesitant when people are overly optimistic about what the future brings. I happen to be a very optimistic person, but when it comes to business, I try not to have much optimism. So I think that I get nervous when I'll see someone come to me and say, look at this deck. They're returning 30% returns in 2 years. And I say, okay, so that's possible because we see those returns as well. But what are they looking at for their projections as far as the sales side? What are those cap rates that they're selling at? What are those assumptions that they're making as far as what's going to happen? And how much is speculative versus how much is actual, or what is that plan of how to get from A to B? And if that plan includes a lot of luck, and a market that shifts and some fortune telling, that's where I would get hesitant.
What's the most important metrics that you track? It could be personally or professionally.
Yeah, we really like to aim to look at about 50 deals a week, underwrite about a dozen deals a week, and make one or two offers a week. So those are some metrics that we use. But we are very metric based as far as our company. We operate off of a system called EOS. It's a book called Traction, if you've ever heard of it. And everything is about metrics and numbers. So every employee in our company has numbers that they have to hit and metrics that they have to hit. And that's really what tells us whether we're on track or not.
Awesome. Yeah. If you're not measuring it, you don't know if you're improving or not, do you? What about some
Correct.
habits that you have, Amy, that have helped you produce the highest return that you're disciplined about?
We are able to pivot really quickly. And I think you mentioned this before, but it's really important. Real estate market shifts on a dime, and we have to be able to adjust and reevaluate the deal every day. And so we're constantly looking at what is the value of this deal today? Are we headed in the right direction today? We started out with a plan. Is that plan still valid, or does that plan need to be adjusted? And we really want to make sure that we have flexibility so that we are really adapting every day to what the market is. And that's one of our core values is flexibility and adaptability. The other thing is to keep up a positive attitude through everything, because we buy crazy distress. And so we expect that there's going to be problems every day. And so I'm always telling my staff, if we know there's going to be problems from day one, we cannot get stressed out when the problem comes on day two. We knew it was going to come. So we cannot allow that to stress us out. We have to stay positive and really continue pushing through in a very steady and level headed way.
It's part of the business, isn't it? The business model. There's going to be stressful things about the deal, buying distressed
Yeah.
assets. So,
That's
uh,
one of our core values is ride the wave, because
mm,
it is absolutely waves, and we are up and down every day, every week. Great successes, major things that go wrong, up and down constantly, and so we just have to ride that out as a team together.
Amy, how do you like to give back?
So we have a program in our office that we just started, which is really exciting. So every single month that our company, that my team delivers financials on time to me and we're within 10% of budget, we like to give a large donation to the community, to one of the communities that we work in. So we're trying constantly to make sure that we're giving back to the communities that we are in and that we are operating in. Mostly we're trying to focus on stuff that has to do with youth, youth education, any sort of support. And we really like to be in those communities that we're in. I think we're really good at hand-holding tenants through finding financial support when they need it. We're good at working out agreements with tenants. We don't like to displace anyone unless we really, really have to. So we do try to be very conscious of the communities that we're working in, very respectful of those communities. And we want to leave a community in a far better position when we leave it than when we started there.
That's awesome, Amy. I love how you're incorporating the whole team in that as well. That's incredible. Well, Amy, honored to have you on to get to meet you, hear about your really just your career, right, in commercial real estate and all the downturns and what you've learned, and helping us to think through that as well, especially with Class C or distressed assets and the value that you all are creating there, right, for your investors. Tell the listeners how they can get in touch with you and learn more about you and Clear Investment Group.
Our website is clearinvestgroup.com, and we have more information about who we are there. And there should be an information emails there to get in touch with us through that website. So yeah, I encourage anyone to reach out and ask us questions and let us know what you want to hear, and we're happy to share.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.